You're listening to Simply Put, a podcast from FHN Financial. Filling in for Will Compernell, I'm your host, Mark Streiber, economic analyst at FHN Financial. Attacks on the Federal Reserve's monetary policy stance have brought the institution into the limelight. The Federal Reserve's original purpose was actually as a lender of last resort, not the wielder of monetary policy and disciple of stable prices and maximum employment. On today's episode, we talk with Kate Judge, professor of law at Columbia Law School, about the role of the Fed as a lender of last resort. Stay tuned. Coming up soon, our interview with Kate Judge. But first, a quick market update. Following the July employment report just 2 days after the July FOMC meeting, markets have been increasingly focused on cracks in the labor market and what that means for a September rate cut. In early August, market-implied odds of a September cut briefly exceeded 100%, indicating a small chance of a repeat performance of last year when the Fed cut by 50 basis points in September. Those expectations were quickly walked back following the July CPI print. Headline CPI rose 0.2 in July, in line with estimates and good for an annual increase of 2.7%, which was a tenth below the consensus estimate. Core CPI was the reason for the change in rate cut odds, as the core measure rose 0.3 in the month and 3.1% on an annual basis. That was a tenth above estimates. There were tariff-related price increases in the CPI data, but what markets and FOMC officials were likely more concerned about was the acceleration in the core services prices. PPI inflation further dampened the outlook for a September rate cut, although odds for a 25 basis point cut still sit just above 70%. Headline PPI rose an outsized 0.9 in July, more than double the highest estimate in the Bloomberg Economics survey. The core PPI rose 0.6, more than triple the consensus estimate. A majority of the increase in the index was due to margins for final demand services, which measures the difference between what wholesalers pay for goods and what those wholesalers sell those goods to retailers for. Margins have produced some violent swings so far in 2025, and the index for margins is likely to decline sharply next month, leveling out the spike. Overall, the producer price index has barely risen this year, averaging gains of just 0.2 per month since January. That's a number consistent with 2% consumer inflation. But the violent swings in the monthly data have some market participants and Fed officials concerned. That's all for the market update this time. Now, our discussion with Kate Judge.
Our guest today is Kate Judge, professor of law at Columbia Law School. Kate, thanks for coming on the podcast.
Thank you for having me.
Our topic today is the Fed's role as the lender of last resort, how they exercise this authority and whether their capabilities are sufficient for today's financial environment. Now, understandably, so much attention is given to the Federal Reserve's plans for modifying its short-term policy rate, the federal funds rate, but the Fed and other central banks also provide several other critical functions to keep the financial system running smoothly. Kate, what does it mean when we say the Federal Reserve is the lender of last resort?
The lender of last resort is actually the original role of the Federal Reserve long before it was focused on interest rates or monetary policy. And the main aim is to provide elasticity into the banking system and the broader financial system and really provide additional liquidity during periods of distress. Mechanically, the way that happens is through collateralized loans. The Fed will take assets that are high quality assets but are not liquid in the current environment and take those as collateral and then provide new liquidity to the bank or non-bank on the other side of the transaction that helps enable them to kind of stay active and to provide liquidity, ideally, further into the market.
And so you said this was the original function of the Federal Reserve. I think it really was the impetus for the formation of central banks in general. So going back historically, did we see a lot of financial panics that were liquidity crises rather than, a lot of other issues that we see today?
We certainly did. And I would actually say a lot of the financial crises we see still oftentimes are at least in significant part the result of liquidity challenges. There might be solvency challenges and capital shortfalls at the core of the crisis, but oftentimes the liquidity dynamics really accentuate the size of the crisis and also make it a lot more difficult to resolve. And yes, historically, liquidity challenges were a core challenge, again, oftentimes layered on top of capital shortfalls of financial crises. And in the United States, part of the reason we ended up with the Fed is it was the lack of a central bank that resulted in us having far more frequent financial crises than countries in Europe and elsewhere that did have central banks that were able and willing to serve as lenders of last resort.
So, in non emergency times, normal times, how does the Fed serve this function? You talked about that collateral to banks or non banks, but who is eligible? What is the process they go through to kind of access the Fed as the lender of last resort?
Yeah, it's a great question. And it depends both on the type of the institution and also are we in an emergency or are we not in an emergency? So, most of the time, the Fed has standing liquidity facilities. There's actually three different facilities that collectively get referred to as the discount window. Only banks can go to the discount window. And the idea here is banks are already subject to robust prudential regulation, oversight by the Fed or one of the other federal financial regulators. And part of their role is providing liquidity to their clients, to businesses and to households. And so we want to make sure that they have the ability to do so. So providing liquidity to banks has been core to the Fed's role during crisis times and outside of crisis times. But of course, it tends to get used less often outside of crisis times. Then when it comes to non-banks, this is where the Fed has emergency lending authority under Section 13.3 of the Federal Reserve Act. And under 13.3, the Fed has the authority to provide liquidity to non-banks. So really almost any type of person or entity, so long as they are secured to the satisfaction of the Reserve Bank in unusual and exigent circumstances. And there's other procedural hurdles there. You need 5 of the 7 members of the Board of Governors to vote in favor of the facility. You need the Treasury Secretary to sign on, and you have to make sure that it's broad-based. So we don't want another situation where you have a bailout of a single institution, as we did with Bear Stearns and AIG in 2008.
I want to get more into those 13.3 powers in just a second, but going back to the non emergency times, the normal times, the discount window, is there any sort of process to keep this under wraps? I feel like what we saw in the 2023 regional banking crisis, it was a good reminder that if a panic is caused by rapid deposit outflows, maybe because people think that their bank is going to be insolvent, it becomes a self-fulfilling prophecy. And if a bank accesses the discount window, it can send a signal. And is there any process then to stop accessing the discount window having this stigma for banks, so that they actually stay solvent and it doesn't perpetuate that deposit outflow?
Stigma at the discount window is a long-standing issue, partly because the Fed has been of two minds. For a while, they kind of liked stigma because they wanted to be the lender of last resort. They didn't want to be the lender of first resort, and stigma helped to make sure that people did not go to the Fed overly quickly. But in recent years, and I would say really for a number of decades now, it's actually been quite a problem where it's inhibited the ability of the Fed's discount window to operate as it should. And again, oftentimes when banks are seeking liquidity at the Fed's discount window, not only does that help the bank, it helps the broader financial system because it reduces their need to engage in liquidity reporting. It increases their willingness to provide liquidity to provide credit on to customers. So there's oftentimes benefits when banks are willing to borrow from a discount window. So you referenced nicely the debacle is now the term I think we're oftentimes using for what happened with regional banks in spring 2023. And that did, I think, crystallize for many the problems with the discount window, which were stigma, but also a number of operational shortfalls, and separately the tendency of banks to rely on the federal home loan banks as lenders of last resort. And we've seen the Fed initially under Michael Barr, but I would imagine they should continue this initiative with new Vice Chair Mickey Bowman, take real efforts to improve the operations and the capacity of banks to use the discount window.
I want to return to the 13.3 emergency power. So you talked about how when this is activated, it does go through a pretty rigorous process where I believe 5 of the 7 Fed governors have to approve, and also the Treasury Secretary is involved. So it's not really just on the whims of an independent, one single independent Federal Reserve official. But during panics, times of crises, it's pretty difficult to tell which institutions are just in need of a liquidity infusion and which ones are insolvent. So, how does the Fed evaluate which institutions are worthy of liquidity without just providing this, no strings attached bailout for a lot of toxic institutions?
I will also say, as you pointed out, like not only do they not know a lot about these institutions, but during periods of distress, you have usually a process of fire sales already going on. And as a practical matter, the Fed's willingness to intervene could really shape whether the institution ends up being solvent or not. So AIG and Bear Stearns both looked like they were solvent, even ex post when the Fed intervened, but the Fed did a lot of other things, and the Congress and the Treasury Department did a lot of other things in 2008 to really steer the financial crisis in a better direction and restore the health of financial institutions in ways that also inure to the benefit of Bear Stearns and AIG. But it's hard to know. There's alternative scenarios that were there, I think, particularly for Bear Stearns. Alternatively, when you look at the failure of Lehman Brothers, although it was not immediately after the fact, within a few days, we saw policymakers coming to agreement in trying to explain their decision not to intervene as being based on Lehman's insolvency. But there's been some great work by academics subsequent to the crisis that suggests actually Lehman probably was solvent or would have been solvent had the Fed intervened. When they didn't intervene, a lot of the value was destroyed the moment they made that decision. So again, it's an incredibly difficult decision. And that's part of the reason we use a lot of procedural safeguards more than substantive safeguards in decisions by the Fed. That's part of the reason we want the Treasury Secretary, for example, weighing in on these decisions, is we know it's going to be imperfect and judgment laden.
I do think there's an interestingly blurry line between insolvency and illiquidity. It's not as obvious as people might think, but to this point, in times of crisis, prices for the collateral that we've talked about, high quality or even medium quality, could be low and or volatile. So let's say that there is this fire sale in treasuries because a lot of institutions need cash, and then suddenly, overnight funding markets, the rates go up really high. Treasuries are going to mature at par. Yet that collateral could be priced pretty cheaply in the moment, which gives a suggestion of insolvency when actually it's probably just illiquidity. Is the Fed lending on this collateral at mark to market prices or held to maturity prices?
So there's discretion there at the Fed, and we've seen them take both approaches, somewhat controversially, depending on the circumstance. The only requirements that are built into the law are one, to try to protect the taxpayers from incurring any loss, and two, the loan has to be secured to the satisfaction of the Reserve Bank. And mechanically, while it's the Board of Governors that is authorizing the creation of a facility, the facilities are actually run by one or more than one of the 12 reserve banks. And so that's the Reserve Bank that has to be secured to their satisfaction. One way that they've managed to do this is the Treasury Department has provided loss absorbing equity when they've set up these facilities. And so one of the key tools that we saw originally used in 2008 and used much more widely in 2020 is they protect themselves against losses, not only by virtue of the collateral that is posted, but because Treasury is in this first loss position, reducing the likelihood the Fed is going to incur any losses.
Now, what types of collateral are we talking about? Because maybe this is just repeating the same idea that there's a blurry line between insolvency and illiquidity. But treasuries, we can say, are high quality. But then what about certain assets that, turned out to be pretty low quality in 2008 that were rated AAA? How do you decide if you should mark to market or mark to maturity? It just comes down to the interpretation of officials at the time, and it is a necessarily imperfect process.
It is necessarily an imperfect process, and there's a lot that goes into determining those haircuts. Again, part of the role of central banks, though, is to provide liquidity against assets that had been liquid before the crisis started, but no longer are. So treasuries are a whole separate issue. There's a separate facility for treasuries. There's been a lot done, though a lot of work remains to be done to provide appropriate liquidity in the treasury market. So a lot of the work that 13.3 is doing is helping to ensure liquidity against other types of assets. We've seen it used for corporate bonds. We actually saw it used, for example, of Bear Stearns. There was toxic assets that JP Morgan said, we just can't value these assets very easily. And so there was a complicated arrangement where losses were divvied up between JP Morgan and the Fed with pretty big haircuts against this pool of assets that was put into this kind of like separately created vehicle. Again, the Fed ended up coming out whole and actually made some money on that. But it was because at the time, those assets were so illiquid and the process of trying to otherwise value these complicated securitized assets were so difficult that they just had to make judgment calls given the short time frame.
I get that in times of crisis, there's an instinct to really just throw the kitchen sink at the problem. In March 2020, or the onset of the global financial crisis, we didn't have the luxury of doing fine tuned analysis or having much patience. But is there a point where over intervention can have serious costs? How do we know that the recent usage of 13.3 powers, either in 2023, 2020, or 2008, were effective rather than an unnecessary layer on top of some other support that was actually doing the heavy lifting?
So this is one of the chronic questions. And again, it's not specific to the Fed or to the United States. We saw the Bank of England somewhat controversially go in and intervene in the gilt market. And again, that was a relatively short-term intervention, but it was nonetheless, they were providing additional liquidity even during a period of tightening. And so I think there has been a widespread fear that expectations of central bank support have become so widespread that people fail to appreciate the liquidity risk with a variety of financial assets that are not necessarily that liquid, particularly during periods of distress. I will say Congress has accentuated the challenge because, particularly in 2020, Congress was the body that made the decision to say, look, there's a lot of companies out there in the real economy that probably need access to credit and might have a hard time accessing it. So we're going to give $454 billion to Treasury. We wanted to lever that up, 10 to 1 by investing that effectively in 13.3 facilities that the Fed creates. And they didn't end up using nearly that much money, but it really was Congress who was asking the Fed to intervene quite broadly in that instance.
My understanding is that between the Great Depression and 2008, these 13.3 powers were not used. And so 2008 was an existential crisis that we needed to enact these emergency powers. Spring 2020 with the pandemic, certainly so. But then the spring of 2023, the regional banking debacle, as you called it, I wouldn't say that in the 90 years since the Great Depression, that the regional banking debacle seems like one of the top three candidates for when to use these emergency powers. Do you think that the fact that the Fed chose to do that or needed to do that shows that our current regulatory framework is ill-suited for the structure of today's financial system? Because as I see it, the 13.3 powers are trying to minimize pain after something kind of breaks, whereas regulations are trying to stop an issue from happening at all.
Yeah, so let's break that down a little bit because I think it's really useful to think about different types of 13.3 facilities rather than grouping them all together. I mean, one clarified note that I think is actually informative here, even though 13.3 wasn't actually used in the sense of creating a facility that ended up making any loans, it was invoked twice in connection with the S&L crisis. And that matters because at that time, savings and loan institutions and building associations were actually outside of the regulated bank system. They were separately treated as thrifts. They didn't have direct access to the Fed. And so part of the reason they probably need to use 13.3 was they needed a mechanism for getting liquidity into financial institutions that had some bank-like characteristics, but weren't banks. Similarly, 2008, one of the big challenges that we saw is we had this huge non-bank financial intermediation system. It was undertaking liquidity transformation and maturity transformation, much like the banking system, But again, because it was happening to a variety of different interconnected entities, that none of which were banks, it was not subject to the same prudential regulation. And so we really weren't prepared for it. So I think we have this core challenge where, yeah, when the Fed intervenes, I think we need to then allow the Fed to intervene because we don't want liquidity problems to create a contraction of financial activity in ways that have a spillover to the real economy. But I do think every time that happens, there should be a rigorous look back to think, why was this necessary? Was there a regulatory shortcoming here? And what are the potential reforms that we need to undertake that are revealed to us by virtue of the need to invoke 13.3?
It's interesting to know that about the savings and loan crisis because, maybe had this idea that shadow banks and non banks had proliferated since the financial crisis or maybe leading up to the financial crisis, but non banks have always been a part of the financial sector. Is it regulatory arbitrage? I mean, is it just a tough balance between letting different institutions innovate in ways that are different than traditional banks, but also making sure that these systemically important institutions have the backstop that they need? I feel like there is a delicate balance there.
It's an incredibly difficult balance, and it's one that's long-standing to our system. I mean, if you go back to the creation of the Federal Reserve, again, the focus was on banks, but actually the panic of 1907 that triggered the need for a central bank and finally built the political will to create the Federal Reserve System started in the shadow banking system of the time. It started with a bunch of trust companies that were outside the clearinghouse system that the banks had set up for themselves. And again, as you're alluding to, it's oftentimes two different factors that are intertwined that are leading to the growth of these non-bank spaces. Part of it is regulatory arbitrage. If we're going to make it costly for banks to engage in certain types of activity, some of that activity is going to migrate outside of the banking sector. But some of it's also technology has really allowed for different types of financial innovations that allow non-banks to provide services that we traditionally were only be able to provide effectively for banks. And so the trying to find that right balance is something we still haven't figured out. I will say, even though the 2008 financial crisis really emanated in the non-bank space, the reforms were far more effective at bringing stability to the banking system than stability to banks, non-banks. We don't yet have a good system in the United States for how to deal with systemic risk outside of the banking sector.
So that leads me to my next question, which is any of the recent regulatory reforms in the news we've heard about, supplementary leverage ratio reform, the Basel III endgame, do these apply to non-banks at all? Or even as we shift from Michael Barr to Mickey Bowman being the VC for supervision at the Fed, are we going to see a lot of regulations focus on the traditional banking sector and that difficulty of figuring out how to incorporate non-banks and shadow banks into the regulatory framework just continues to be an ongoing problem?
It's going to continue to be an ongoing problem. The Fed has direct regulatory oversight over a variety of different types of banking organizations, including the large bank holding companies. It does have oversight over some of kind of the non-bank utilities. But where it really has fallen short and the post-crisis regime has fallen short is part of what we realized during the crisis is, oh, look, like this activity is migrating outside the banking sector. We need to have mechanisms in place that allow regulation and prudential oversight to migrate accordingly. So we set up this Financial Stability Oversight Council, and we gave them two key tools. They said, look, if the activities are the problem, then look to the financial regulator that has the authority over that activity and get that primary regulator to take action. If the challenge is we have a systemically significant financial institution that's a non-bank institution, well, we should designate it systemically significant, and then it will be subject to Fed oversight. And for a while that worked. We saw AIG and other insurance companies and GE Capital designated, but then we saw MetLife challenge their designation. We saw all the other financial institutions that had been designated, de-designated. And right now, even though we just had 4 years of a Democratic administration, we have zero designated non-bank financial institutions, despite the clear significance of the non-bank space. And so I think that's just a sign that we don't have the right architecture in place to deal with those risks.
I want to end with a question looking towards the future and maybe your policy prescription. So it's inherently difficult, maybe even impossible, to predict the next crisis. But do you think the current structure of these 13.3 facilities will be sufficient for the next liquidity panic? What would you do to strengthen it, or where do you think right now it could potentially fall short?
Let's strengthen it in part by putting more emphasis on structures that are not under the Fed's control, but instead are really under the control of more politically accountable bodies. So, for example, we saw during the Great Depression, like when banks get into trouble, part of what they need is not liquidity. It goes back to your original point. Like a lot of times there's a solvency problem. We need to really solve the solvency problem. And so maybe part of what we should do is actually have kind of lending facilities that are not just collateralized lending facilities, but that also have the ability to buy preferred stock. It's what we did in 2008. It's what we did more successfully in the 1930s with the Reconstruction Finance Corporation. So we need to think ahead of time. We don't rather than just trying to put those things together on the fly, think ahead of time strategically over what that looks like. And even for liquidity support, I would actually say we should allow greater flexibility for there to be temporary guarantees. But again, for that to come with a lot of strings attached, including regulatory reform, and for those types of programs to be administered by the Treasury Department instead of the Fed. I think the Fed's going to be in a better position to maintain its independence with respect to monetary policy if it's playing a smaller role in some of these more fraught decisions regarding how best to stabilize a fragile financial system.
Kate Judge, thanks for coming on the podcast.
Thank you so much for having me, Will.
That was Kate Judge, professor of law at Columbia Law School. Her expertise in the Federal Reserve's role as the lender of last resort and liquidity supplier in the financial markets provides a deeper understanding of the important background functions of the Fed, and how important a role those background functions play in keeping markets stable and liquid. Friday brings the most important event of the week in Fed Chair Powell's economic outlook at the Kansas City Fed's annual Jackson Hole Economic Symposium. Not only will Powell deliver an economic outlook, but he will also likely update markets on the Fed's policy framework review and their policy framework for the next 5 years. We do not expect Powell to telegraph a rate cut in September like he did last year. Rather, we expect him to declare September to be a, quote, live meeting, and that the Fed's decision will be determined by the totality of the incoming data. The two most important data releases between now and the September FOMC are the August employment report and the August CPI report. Next week is the first of 3 important weeks of economic data that will likely shape the Fed's September policy decision. The week kicks off with new home sales and a few regional Fed surveys on Monday, followed by July durable goods orders, June housing inflation data, and August Conference Board consumer sentiment on Tuesday. Thursday brings the first revision to second quarter GDP and pending home sales for July. The most important release of next week is Friday's personal income and spending and PCE inflation report. Personal income and spending are both expected to rise by 0.5 percentage point, while core PCE is expected to rise by 0.3. Personal income and spending are more important here because they provide a first look at third quarter consumption and income outside of the July retail sales report. Consumption posted the weakest back-to-back quarters since the pandemic in the first half of 2025, despite decent increases in income. Retailers and economists are looking for that pent-up income to return in the form of faster consumption growth in the second half of this year. The following week kicks off with the August ISM Manufacturing Index on Tuesday, which is expected to be unchanged at 48. Markets will be watching the prices paid component to determine whether most of the tariff-related price increases have already worked their way through businesses to consumers. We will also be watching the prices paid component of the August ISM Services Index on Thursday, as the services prices paid index is often a better leader of the CPI index. The most important data release before the September Fed meeting is the August jobs report on Friday, September 5th. The current median estimate shows 90,000 jobs added in the month, and the unemployment rate being unchanged at 4.2%. A weak print will all but solidify a September rate cut, while a better than expected print will put a rate cut into serious question. Keep an eye out for the 2-month net revision as well. Another significantly negative revision could boost rate cut odds more than the headline payrolls print. That's all for today's episode. Thanks again for listening. I'm Mark Streiber, economic analyst at FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments.
This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.